Welcome back to FTfm. Exchange-traded funds that provide exposure to bonds are attracting record inflows from investors at the same time as many fund managers are warning about growing signs of stress across fixed income markets. Joining us to discuss bond ETF flows and fixed income market liquidity is Pybus, European Head of Fixed Income Strategy for iShares, the ETF arm of BlackRock, the world's largest fund manager. Welcome, Brett.
Thanks, Chris.
So, bond ETFs attracted record inflows in 2014. That momentum has carried over into this year with inflows of more than $50 billion so far this year. What's driving that growth?
Well, we're really seeing growth in fixed income ETFs being driven by a range of factors. Existing users are using fixed income ETFs more broadly in their portfolios. And then, more interestingly, perhaps, we're seeing the usage of ETFs being adopted by new investors, particularly institutional investors. So we're seeing the likes of investment managers, hedge funds, sovereign wealth funds increasingly using ETFs as a tool in their portfolios alongside cash bonds or derivatives perhaps, just as another way of expressing a view. Some of the more common applications that we see from these investors include tactical asset allocation, so expressing a beta view in a given market. It's fairly easy, cost effective to express that through a fixed income ETF rather than trying to source the underlying securities perhaps. We're seeing some investors use ETFs as a tool to manage cash flows in a portfolio, so to manage their portfolio beta while they have inflows or outflows. We're seeing ETFs used in other, perhaps more unusual ways, so as part of a transition assignment, perhaps an investor's looking to go from one active manager to another and uses the ETF as a place to effectively park assets with market beta exposure while they undertake that manager search.
So, at the moment we're seeing lots of warnings about liquidity conditions in fixed income markets deteriorating. Is that affecting bond ETFs?
What you say is true. We have seen trading liquidity in individual securities decline, so it's become more challenging to transact in specific bonds from time to time. We've seen fixed income ETFs, by contrast, grow. So we've seen their asset base grow and we've seen their liquidity actually increase. One of the key drivers behind the growth of fixed income ETFs, in our opinion, is this challenge to liquidity broadly in fixed income markets. Part of the key to thinking about liquidity in ETFs is to understand that they trade on an exchange. So what they do is they give investors the ability to exchange risk, to match off buys and sells at the exchange level without necessarily impacting the underlying market. So this can be very efficient, it can be very cost efficient for these investors, and it provides another avenue for investors to express a view. So in that sense, this is the incremental or additive liquidity that ETFs bring to the market. So we're seeing ETFs being used increasingly precisely because investors are finding it perhaps more difficult to navigate the current market.
What if there is a big disruption, a big liquidity event in fixed income markets? Do you think bond ETFs will still be able to live up to their promises in those circumstances?
We've seen ETFs manage through periods of stress before, and we've seen how our fixed income ETFs have behaved through those periods. So what you tend to see is that volumes increase during periods of stress. So investors are actually gravitating towards a venue that offers liquidity. The key thing with fixed income ETFs, the key benefits that we see them bringing to markets, particularly during stress periods, are price discovery and price transparency. So they provide a window into what can be otherwise opaque fixed income markets. Investors can see where risk is being bought and sold and at what levels. Increasingly as well, because of the liquidity that they're able to provide, they also enhance the stability of markets.
So there have been some suggestions that regulators should impose restrictions on fixed income mutual funds to try and prevent problems if there is some kind of disruption in the bond market. But are those kind of proposals workable for ETFs?
So we understand why market participants and regulators are very concerned about these issues. We understand why fixed income ETFs effectively get the attention that they get, despite being a very small part of the overall market. You mentioned impressive growth figures. Fixed income ETFs globally are still only $460 billion, so a relatively small part of a very large market. At BlackRock, we are committed to continue to work with regulators, with clients to educate, whether it's around markets, whether it's around products themselves. We think our risk management capabilities position us well to evolve both our products and help regulators and clients understand how to interact with those products.
Pybus of iShares, thank you very much for joining us today.
Thank you.
And for more on this topic, go to ft.com/FTfm.